Have you ever wondered what it means when traders talk about rolling an option? Well, let's break it down. When you roll an option, you're basically doing two things at once. First, you close your current option position, and then you open up a new one. It's like switching from one option to another. You do this by placing a trade called a spread. There are different types of spreads, but they always involve buying and selling the same kind of option, either both calls or both puts. So why do traders roll options? Well, the main goal of rolling an option usually falls into one of three categories: to make your trade last just a bit longer, to reduce your risk, or maybe to take some profit off the table. Let's take a closer look at each one of these using a profit loss diagram. We break down this tool in a separate lesson, but it shows you the potential profit and loss of a trade based on the price of the underlying security. Let's start with how to make your trade last a little longer. You do this by using a calendar spread to change the expiration date of the option in your initial trade. For example, say the stock is trading at $20 right now, but you expect that stock price to rise in the next 3 months. To take advantage of this, you sell a $20 put that expires in March, receiving a total credit of $100. Now keep in mind, this isn't including commissions and fees. Now let's fast forward a little bit. Imagine that it's March, just one day before the expiration of your option, and the stock price is at $18. That's not an ideal situation. As your profit loss diagram shows you, you'll likely have a loss of $100. But you can give yourself more time for the stock price to potentially go up by rolling the March put to a later date. You buy to close the March $20 put and sell to open the June $20 put, effectively rolling your option from March to June. You also receive $100 for the trade as well. This shifts your profit loss line up by $100. So now you have 3 more months for the stock price to potentially go up above $20, and your maximum potential profit is double what it was originally. The downside is your money is tied up for a longer period of time. Plus, you've placed another trade, which comes along with additional commissions and fees. Now let's talk about reducing risk. To do this, you can roll your option to a different strike price using a vertical spread. For example, say a stock is trading at $50 right now, but you expect the stock price to rise in the next 3 months. To potentially gain from this scenario, you're going to buy the $50 call that expires in March, costing you a total of $500. This means your maximum potential loss for the trade is $500, and your potential profit, that's unlimited. Now imagine it's January with 2 months until expiration, and the stock price is at $48. Now, since this trade isn't exactly going well, you can reduce your maximum potential loss by rolling the option for a credit. To do this, you can place a spread trade that brings in a net credit. You sell to close on that March $50 call and buy to open on a March $55 call, rolling your strike price up from $50 to $55. By placing this trade, you receive $200, shifting the profit and loss line up. This means that you've reduced your maximum potential loss by $200, and you've still got that maximum unlimited potential profit. The downside, well, your break even is going up as well, up to $58 instead of $55, which means you've increased the chance that your trade might be a losing one. And placing an additional trade also means there could be additional commissions and fees. Lastly, let's discuss some profit-taking options for you. To do this, you can roll an option to a different strike price using, once again, a vertical spread. For example, say a stock is trading at $60 right now, but you expect that stock price to rise sometime in the next 3 months. To gain from this, you buy a $65 call that expires in March, costing you $200. This means your maximum potential loss for this trade is $200, but the potential profit here, it's unlimited. Time passes by, and now it's January with 2 months until expiration, and the stock price has gone up to $72. First off, well done here. If only all trades were this easy. But secondly, let's think about locking in some of those profits. To do this, we can place a spread trade that brings in a net credit. We're going to sell to close on those $65 calls and buy to open on a $70 call, rolling your strike price up from $65 to $70. By placing this trade, you're going to be receiving $500, shifting your profit and loss line up. This means that you've locked in a profit of $300 and still have the potential for unlimited gains. The downside, well, you risk losing some of your unrealized profit if your $70 call expires worthless and out of the money. Plus, you may have additional commissions and fees to consider. So, to recap, you can use a calendar spread to extend the expiration date of your trade, and you can use a vertical spread to reduce the risk or take profit from a trade. That's it from this lesson. Happy rolling. Have more questions? Check out our on-demand videos and learning paths, interactive master classes, and live webinars with guest speakers from around the industry.